Hey everyone, my name is Dante Reminick. We're going to be talking about stablecoin settlement in card networks and cross-border payments. In my opinion, this is probably one of the use cases that has the highest levels of PMF out of any use case in stablecoins, and we have an absolutely stellar lineup today who are going to be here to chat about it. So I have a million questions for all of you, but I'm going to leave hopefully some time at the end for all of you in the audience to ask some questions as well. But without further ado, let's get started with some introductions. If we could just go down the line, who you are, and also more importantly, what your company does in sort of the payment stack. We have a really interesting mix of people here today, and also how you guys are using stablecoins. So let's get started.
Yeah, hey, good to meet everyone. So Malcolm Clarke from Western Union. So Western Union, really small company, about 175 years old. We're using stablecoins in three big ways. So we launched our own stablecoin asset called USDPT. We have liquidity management with that asset between ourselves and our agents to remove capital. We have a digital asset network, which allows partners to use our off-ramping for cash and on-ramping for cash around our 500,000 global agents. And then we're about to launch a stable card with our friends Visa and some others. So happy to be here and talk about this.
Hi everyone, my name is Ahmed Zifzaf. I'm the head of crypto partnerships at GlobalPayments. We used to be WorldPay, but we've recently merged. Today we're now the largest globally merchant acquirer, payment service provider. We do about $4 trillion in global payments volume. When it comes to stablecoins, more generally, we sort of sit as this infrastructure player in between the card networks and the merchants. So think of if you're going to like a Walmart, any sort of global company, and you're making a transaction, we essentially operate as like that payments infrastructure layer, allowing for. I think the introduction included like things like fraud prevention, chargebacks, authorization. That's sort of our bread and butter and what we do. When it comes to stablecoins, unlike Western Union, we will not launch our own stable. We are not going to launch our own wallet. We're going to be pretty agnostic when it comes to what types of tools and assets that we use, similar to the fiat world. We support dozens of different currencies across 170 countries. We view stablecoins and sort of digital assets as just an addition to already the fragmentation that we already deal with and how we kind of collect it. So yeah, pretty excited about this panel. I pretty much know everyone on this one, so it's, I think, a great one.
Yeah, good friends up here. Hi, everybody. Nice to meet you all. My name is Brian, and I lead payments and partnerships at Polygon. I actually was formerly on the Visa crypto team, and so I help lead stablecoin settlement there and stablecoin cards specifically. Stablecoin settlement has been booming over the past 2 years. Went from $50 million in run rate when I was there to now we're $5 billion. I don't know what the new number is, maybe.
Over 7.5.
That's a big number.
Don't spoil anything.
Yeah, we'll get to it. And I'm currently at Polygon right now, and I'm sure you all understand that Polygon is a legacy blockchain company, been around since 2017, moved trillions of dollars in stablecoins. But ever since January of this year, we acquired two companies, one called Sequence, the other called CoinMe, for $250 million. And those two companies brought us on and off-ramping capabilities in the United States. We now have 35 money transmission licenses. We have non-custodial wallets we issue globally, custodial wallets as well. And the reason we did all of this is because when I was at Visa, I saw it very much plainly. A lot of these enterprises, don't want 3 vendors in order to get into this space. They need one contract. They need all the infrastructure to do it. When I was at Visa and somebody wanted to do something in stablecoins, you'd point to one wallet company, one ramp company, and you did it all in one condensed stack. And so that's why I joined Polygon, because we offer that full stack infra for these enterprises to get on chain. And yeah, John Egan, our chief product officer, has a saying at Polygon where it's full stack or die. And I tend to agree with that.
Yeah. So Brian, good to see you.
He's also my former manager, Pete. So.
Yeah. So this is Pete from Visa Crypto. We are a large global payment network that I think many of you have heard of. We, I think, have around 5 billion Visa credentials throughout the world. I think last year we did around $15 trillion in payment volume settlement on core VisaNet. That is historically done over Fedwire and SWIFT, right? So when we're talking about settlement, which is the topic today, historically that is done over banking rails that I think most people are probably pretty accustomed to. That has been augmented and added, we've enabled stablecoin rails as well to settle obligations. So issuers can settle obligations to us in stablecoins. We can settle obligations to acquirers in stablecoins. That is changing the way money moves. We are a network of network, and this is just other networks that we're incorporating into our full stack. If I may steal a line. Yeah, I mean, we support 5 stablecoins today across 9 chains, and it's a kind of burgeoning area for us. And as well, we support a lot of crypto exchanges as well as non-custodial wallets with card issuance. So I think we have like 130 some odd programs around the globe where people are spending down it could be a Bitcoin balance, they could be spending down a stablecoin balance, and they're able to get access to 175 million merchants that accept Visa today. So a lot of work we've been doing and a lot more work to follow.
Awesome. I hope that you guys see why I'm so excited for this panel. First, real question for you guys, and we can, Pete, start with you and go reverse. I think a lot of the times when companies come into the stablecoin space, they think about it in terms of, oh, how many users have stablecoins or how many merchants are willing to accept stablecoins. But the reality is, throughout the entire payment stack, the companies themselves and the stakeholders in that payment flow can also use stablecoins themselves to improve their own systems and to make sure that they can become more efficient. So Pete, again, starting with you, how are you guys using stablecoins internally, not just offering it as a solution to people? And what does that mean for customers who might not even know that stablecoins exist?
Yeah, so I've talked to a lot of merchants, a lot of very large merchants over the last couple of years, and a lot of them actually come to us and said, we're interested in accepting Bitcoin as a form of payment, or we're interested in accepting. No, it's like I've gotten these questions, or we're interested in accepting stablecoins as a form of payment. And I'm like, oh, that's interesting. That's great. Oh, by the way, you actually already accept Bitcoin. You already accept stablecoins because, of the fact that we've put credentials around a lot of these wallets. So people are able to actually spend those today. So we've kind of obfuscated that and enabled that to occur kind of naturally through the Visa network. And then when you talk about kind of the use of stablecoins, like, when I mentioned that we use them for back-end settlement, like that is not a front-end consumer concern, right? Like as you guys use your cards, whether you're using a fiat-based card or a crypto-linked card, your concern is not the settlement that occurs between issuing banks and acquiring banks, and but that's a concern for us, and that's what we operate every day. I mean, we connect 15,000 banks, and we facilitate settlement in a whole host of currencies all over the globe, 200 plus countries. So we've looked at stablecoins as a plumbing layer to make that more efficient. And there's a lot of advantages that we're seeing with that. First and foremost, the fact that we can do this 7 days a week, right? Because as I mentioned, these banking rails that we've used historically, hey, they're only available when banks are open during the week, or hey, there's a bank holiday, they're not open, money doesn't move. Obviously, that's changed with these rails, and we already have plenty of issuers that settle their obligations to us every day of the week. And one question we get when we talk about that is like, well, why would anyone want to settle with you faster? Like, what's the point in that? Because why wouldn't I hold my funds? Well, it's a great question. It's a very logical question. But the thing to take note of is that, we're a network that connects these partners and distributes funds. We don't necessarily trust everyone. So we're going to hold collateral, from an institution because we need to make sure if they don't pay that we can pay out the other side. In paying us more frequently, they've reduced our collections risk. And then when they reduce our collections risk, we return collateral back to the institution, back to the Visa principal member. That's been really impactful for our partners because it's kind of a perverse thing where, if you are more successful, you actually have to provide us more collateral. That's a perverse thing. So we're fixing that.
Yeah, so I come from the Pete Wexler coaching tree, so we might speak the same language a couple ways. But just to tag on to it, so specific to the settlement piece you were just talking about for issuers paying more frequently and getting a reduced collateral requirements from that has a trickle-down effect to the consumer at some point. But let's just talk about it from a collateral standpoint. So the way it works right now is there's a weekend gap and there's sometimes a holiday on Monday. That means traditionally a bank cannot pay their issuing balance to Visa until like the next available bank day that it's open. And what that leads to is, Visa again doesn't trust you. So they're going to hold, multiple millions of dollars worth of payment volume, right? In order to make sure that if you don't pay like on that day you're supposed to, they can pull from that collateral and perform that settlement like they always have to, right? And so when you can perform settlement 7 days a week, you can reduce those collateral requirements. And what that leads to is about like 3 to 8 basis points you just opened up for your payments experience, right? Because now you're getting this money back and you can put it in higher ROI initiatives. You can go put it in your marketing spend, your product spend, whatever it needs to be, things that yield 6 to 7% as opposed to Visa just holding the money for you, right? And what that leads to is a trickle down to the consumer at some point, right? Like think about back in the day, right, people used to use wires. ACH was not a thing, right? And it actually used to cost money to send money from one place to the other. Like switching banks was a huge issue. And now ACH is available. It's been available for like, what, 10, 15 years. And then companies like Chime came in and said, we're going to offer free accounts, right? We're going to make it really cheap to be able to fund our accounts. And these new fintechs have come and used these low-cost rails in order to acquire new users. And you're seeing the same thing with stablecoins now and these stablecoin neobanks popping up, acquiring users because they can offer better cost efficiencies than the traditional infrastructure can.
Yeah, I guess I like the topic of trust, and I guess I would call WorldPay GlobalPayments like the protector of the untrustworthy of some sort. You know, we represent the merchants like to the networks, so in that way, everything that they're talking about, the trickle-down effects, like we are, I guess, like the first big stop in terms of how the trickle-down really comes about. When I think about how we internally use stablecoins, and I think Pete used the word plumbing, like I already consider the company as a whole the plumbing infrastructure when it comes to payments. So everything that we do, both in stables or not, can be kind of considered both back end and front end in some way, shape, or form. When it comes to stables, that's really interesting is like everyone talks about T+1 or T+2. And in those moments where, you know, funds are not being settled back to the merchant, essentially companies like WorldPay are offering financing to these merchants. So when we talk about moving to a T+0 or even a real-time payments, what we're talking about also for a company like WorldPay is that we don't have to extend credit that much. We can use that money, especially in like a high interest rate, rising cost of capital environment. It's both good for our business and then good for the merchants themselves. So I think, kind of to your point, Ryan, it's like, yeah, the trickle-down effects are almost immediate when it comes from our vantage point, and then it's like our responsibility to then make sure that the merchants themselves benefit.
Okay, so we sit on both sides. So we settle with Visa, occasionally. No, T+1.
Thank you.
We are moving to the stablecoin rail with Visa. But for us, how we're looking at this, we're looking at it from a two-sided picture. So much like we settle with our agents. So at the end of our chain, when you send money, is an agent, which is a physical store. So they have cash sat in register that we will pre-park when it's a weekend or a holiday. So we have a capital funding challenge, which is cost. That means globally, we move $130 billion plus a year. That capital cost is high percentages. So with a stable coin, we can now settle to the agents instantly, directly into their wallets, 24/7, 365. They use that and exit to cash locally. So they take the FX, they decide when to do it and how to do it. We earn yield on what is not parked anymore and not used. So we've gone from a negative capital to a plus capital cost, purely by changing the mechanism of settlement with that stablecoin. So that's the economics that we drive with settlement in stablecoin. It's a very different play than using the fiat rails. Now, we'll still be fiat, and there's still fiat because our customers predominantly still want cash. So the challenge then is the last mile. So that's how we look at it from a treasury point of view. Now, the opposite side to that is making the stablecoin liquid for customers. So with a stable card, which we've mentioned a few times, which is essentially a card which has a stablecoin balance as a true balance available, customers can now move that through the network, take it on a digital card, which means it doesn't go through the agent network. It's instantly available. They spend it in Visa. They take it out in cash in store. So we're reducing even further the capital cost of sending fiat. And then lastly, we have the open network side where we have a bunch of partners that will use our networks, whether it's agents or they're taking funds in and they settle back with us. Much like the Visa problem, we give them credit lines, we underwrite them, we hold collateral. If they settle in coin, then we don't need to take as much collateral. They need to send collateral at a weekend or need to refund us back at a weekend. They run out of credit, so they can't give our customers money. So we're really two-sided in this play. So not only sending out, but settling back so they can continue to pay out for the customer. So that's how stablecoins is really changing the business for us in a very rapid way.
Malcolm, you mentioned that last mile is always the hardest. More questions. Sorry, can't escape that easy. You mentioned last mile is always the hardest. I hear this time and time and time and time and time again. First mile and last mile is always the hardest, and part of the reason for that is today it feels like there's sort of two different ecosystems. There's the on-chain ecosystem and there's the off-chain ecosystem. When is the last time you guys tried to on-ramp with like a credit card? Show of hands, anyone tried to do that recently? Yeah, you laugh because it's really, really hard to do, right? Like, the reason for this is because there's this thing called MCC 6051, a merchant category code, which basically says that anytime you try to use your credit card, and it's not just stables, it's like all crypto, you're going to see really, really low acceptance rates across the board. Wholly, right? And that's because of MCC 6051. How do we fix that gap between the on-chain economy and the off-chain economy? And again, this is not just a Visa thing. Everywhere, really, really hard to get money on-chain with cards. How do we make sure that that line between on-chain and off-chain is blurred, invisible, gone?
Yeah. So I think Peter's here today because he's announcing he's going to personally fix it. Well,
Yeah, I think personal funding.
Like
I'm going
Visa
to announce that it's already fixed.
It's done. So next question. No. I think you've got to look at it in two ways. You have to give more opportunity for normal customers to on-ramp into the digital asset space. So most of the customers in Western Union, I think general terms, they don't care whether we're moving stable coins, unicorns, rainbows, emojis. They really don't give two monkeys. So for us, going
That was a good catch, by the way.
Yeah, I nearly swore. So using the store to bring cash in and load it into a digital asset that then they can use to buy crypto, do things in that crypto ecosystem is one opportunity where you reduce the need for that. In store, using a credit card, we're still going into the same challenge because that still exists. Then on the opposite side of off-ramping, that network is there as well to do it. So I think you look at it in giving that opportunity. I think until the networks themselves, see stable different than a crypto and the risk is different, because it's not a tradable asset, it's a monetary movement of a value that is already in a treasury bank, that change has to happen. And maybe there's a new MCC code. Like, it sounds like a license plate you should put on your car. That code.
Yeah. So Pete just needs to step up and solve it.
The voice of Visa in stable needs to step up.
I think I should go last.
Let's have you go last.
Yeah. I mean, the question I really like just because, I mean, that's like core to what WorldPay or GlobalPayments does. Like in the crypto industry, we've been doing exactly card acceptance for crypto purchases since 2014. So if you have in the last, 12 years bought on an exchange or a wallet using your credit card, it's often like our infrastructure that you're using. So we're quite familiar with, the pros and cons to like what the current system looks like. To your point, Malcolm, I think ultimately this just becomes like a definitional sort of thing where, I mean, correct me if I'm wrong, and I'm going to keep, using our Visa guys, but the MCC code was initially created for, I think, traveler's checks and like foreign exchange. So you can imagine that what we're talking about is not even purchasing a digital asset. It is actually the stablecoin settlement piece, but it's already derived from something that in and of itself is a very different primitive than what we're talking about as a whole. So I think, I'm guessing it's just a matter of time before like this is sort of fixed. But I'll let like one more speaker and then Pete can kind of.
Pete, you're getting beat up here, man.
Yeah. No, I got your back. Don't worry. So
I'm very comfortable.
So I think the obvious solution here is obviously there should be an MCC code for crypto and there should be an MCC code for stablecoins. I think that's pretty frank, right? Like cryptocurrency is an investment, stablecoins is a payment mechanism. And so that's where you're going to have to start. Actually at Polygon, we let people on-ramp with debit cards and also with cash on-ramps. So you can go to like an ATM at a Walgreens and on-ramp. And, I don't know if you've ever went through the on-ramping experience of cash into Bitcoin or like into stablecoins, but there's like 8 warning screens when you're doing it because they're so scared. Grandma's on the phone with the fisher, like walking them through the entire thing. But, still people have to do it for remittances, right? And same thing with debit cards. And this is not new, right? Like credit card, I'm not sure credit cards are going to be used to buy stablecoins. Like you don't use a credit card to get Zelle money. You don't use a credit card to get Venmo money, right? They don't accept that at the end of the day. And like because these are P2P payment systems, right? Like the money is going to leave and Visa's not going to be able to go figure out who they sent the money to, claw it back, right? That's why I use a credit card, right? When you're paying for something online because Visa, and they're really good at this, handles disputes, right? And that's what a credit card is really used for. So I don't think it's the right battle, personally. I don't think Pete's going to be able to change that, where you can use a credit card to on-ramp into stablecoins, because you just don't really see that today with like other P2P mechanisms as well. So I got your back, Pete. Trust me. Don't worry.
Okay, is it my turn?
It's your turn.
All right, cool. So first of all, taking a step back, MCCs stand for Merchant Category Code. Every merchant fits into a merchant category code. Other merchant category codes could be quick serve restaurants, airline, sporting goods stores, you name it. So just the concept of an MCC is not a bad thing. It's actually a good thing. It's just a remark on what the merchant actually is and what bucket they fit into. And there's a lot of obviously data and analytics and other things that kind of fit into that. And there's rules, of course, in respect of those various MCCs. So an MCC by its nature is not a bad thing, just first off. When we talk about the MCC for crypto purchases, one of the things we've done more recently is provide an ability for the payment processor to tag what type of purchase it is. Because I think you alluded to this point, Brian, like there's a difference between purchasing Bitcoin versus purchasing meme coins versus purchasing NFTs versus purchasing stablecoins. Those are wildly different purchases, right? And at the end of the day, like it's not Visa who is saying yes, approve this transaction, or no, reject this transaction. The transaction flows from the point of sale, through the acquiring bank, through Visa, to the issuing bank ultimately, and all the way back. Decisioning is, and there's some fraud controls and other things that, along the way, of course, but like that decisioning is happening at the issuing bank. They need more information, right? So now they're starting to get more information that defines what this transaction is. Oh, this is a $100, stablecoin like on-ramp versus this is a $9,000 NFT purchase and my balance is $10,000, right? And well, that looks a little strange. They might want to reject that transaction. I don't blame them, especially if you've never made purchases before in that category. That hits a fraud check that would say, hey, we should probably reject this transaction. That's appropriate. That I think you actually want that as a customer. So I think a lot of what's been happening historically is starting to get resolved as we've provided more delineation in those transactions. I don't disagree that in the past that's been hard, so I'm not going to sit here and be like, hey, there's no problem, like you guys are all wrong. I'd like to say that, but I think that we've actually fixed this and improved this dramatically in recent time in the last few months, and we've actually issued that out, I think even well over a year ago, but it's only starting to get kind of fully implemented across the board now. So I think you'll see a lot of improvement there.
Awesome. I love it. So, Pete, you're off the hook. You can rest easy. Yeah, exactly. So, Brian, I want to double click into something that you said, which is like, you don't use your credit card to go and, buy Venmo money or Zelle money or whatever it is. But at the end of the day, stablecoins are just money. Right? So like I still use dollars to send money on Zelle. I still use dollars to send money on Venmo. I still use dollars to, buy a can of soda at the bodega, whatever it might be. And so you have all of these really different sort of versatile use cases for stablecoins. Given that stablecoins can do all these things and they're actively using all these things, what are we missing right now? Like where do the gaps lie where you're like, oh, I wish I had this for stablecoins or I wish I had that for stablecoins that would allow all of you guys and all of your incredible networks to go out there and better work with these stablecoins across the whole span of use cases? Brian, go for it.
I'm happy to go. I just moved to New York 2 weeks ago, and I'm still getting used to bodega. I'm like, what is a bodega? I'm figuring that out as I go. But
they're awesome.
Yeah, that's what I hear.
You can get anything at 2 a.m.
It sounds like a liquor store, but I'm just like, okay, bodega. Cooler way to say it. But to your question, I think like what needs to change is stablecoins are still very different from fiat, right? And the reason why is because of the regulation of it. And these stablecoins are not treated like dollars on chain, right? Polygon does on and off ramping for so many different companies right now, millions of dollars a day. And the reason why is because these companies don't want to hold the stablecoins, right? There's a fear in that. So we're still like in this world where we're bridging the traditional fiat infrastructure to the stablecoin infrastructure, and we're doing it quite often because stablecoins are great for the A to B payment, but they're not really good when it comes to holding because people don't have FDIC insurance. There's hacks. There's scary things that happen out there. And so what we need to change, and this is going to be dictated by regulation and also just time, is these stablecoins being treated as actual digital dollars. Now, I think you're seeing some progress on that front. I don't know if anybody from SoFi is in the room, so I'll shout you out for a second. But SoFi USD specifically, it's a stablecoin that can go from a tokenized deposit within their own network, right? It's a tokenized deposit that's also FDIC insured, actually, and then it can go into a second mechanism, which becomes like a stable coin more so, and you can send it across the globe. But when it's in that tokenized deposit world, it's FDIC insured, you have more protections over it. That is something I'm comfortable holding, right? But I am not comfortable holding, like, just a ton of USDC or USDT, even though they're great stable coins, but it's, a lot of these enterprises are still not going to be taking those risks. So you need stuff more like that when it comes to SoFi USD and, like, adding more regulation, more safety into the space.
Yeah, I mean, to add on, I would say from our vantage point, it's not necessarily like a technological or like product gap. I think a lot of what we think about is there standardization of what it means to have like settlement finality. I think across different networks, across different assets, as we've already kind of alluded to, like there's very different mechanisms and very different treatment. So without that standardization, how do I as an acquirer like know what is actually settled on which chain at what time? So I think that's like a pretty big factor, and I think that'll just take time of large enterprises as well as the government and regulator working together to like purely define what that means, so that we have comfort in saying we can accept all sorts of stablecoins that adhere to that standard. I think the second, and I'm sure we'll talk more about this, is like sort of the chargeback dispute mechanism. Like, what does that look like throughout like this payment life cycle? Are we going to have like a reserve pool that you then are refunding from, or are there going to be smart contract like escrow that we accept? Like, there's a lot of different options, and it's sort of just a matter of time in my view until we get there. But like those in my head are like the biggest gaps that need to be solved for this to kind of really go mainstream.
So there's many ways to kind of think about this and answer this. I'm going to start with the flow that we really look at today. So for Western Union, you have a customer that starts a send process. So they're KYC'd AML. So we bring them in, they're a known actor. We can give them a non-custodial wallet. It goes globally. So it starts as a regulated KYC payment in the US. Then we send it to another foreign country. That person receives a stable coin, sits within a non-custodial wallet. It's a completely different legislative place that potentially doesn't have any rules or has some very strict rules. So understanding that difference in what a money transmit means in a stable coin, it's the same as fiat. So those rules still apply, those things happen. When they have that and they exit, then they're in a store instance and you check the KYC and you revalidate them. So from a chargeback finality within our closed network, we have that pretty well covered. Then you're putting the second place, which is the agent piece. So that agent piece, we know the agent, we KYC them, we know their business, we know who they are. So we can settle to that agent based on what they need. They can settle back, much like Visa. There's a trust relationship, we're good. But the legislation in their region is very different. So in Bolivia, they can accept USDT because it's a currency. They can't accept my stablecoin because it's not a currency. Will be very shortly. So they want to swap and they want to flip. The second they start flipping and swapping into all the other stablecoins, you lose the trail. So then anything that happens beyond that, it's their risk, and they have to understand that. The last side of it is we still have that end liquidity problem. So the gap for me is how do we orchestrate out between exchanges, OTC desks, local small exchanges, local banks, so they can take out some of the cost side and keep that regulation side whole. So if you take I send $100 to an agent in Bolivia today, they go through an exchange, there's BIPs, there's FX, there's rates. It's cheaper for me to send it through the corresponding banking layer. So the industry has to evolve a little bit to understand this is no longer retail, it's no longer consumer, it's no longer crypto bro and girls holding it, it's businesses, it's legitimate exchanges going into legitimate agents. That orchestration needs solving. And it doesn't need solving just for the US, it's a global solve. So I think that's where we're hitting up to the biggest challenges we're starting to face is that off-ramping into the fiat world. Because at the end of the day, grandma wants cash. She's going to need it. She doesn't know what a stablecoin is. She doesn't. A Visa card, she'll probably tap it and she may pay a bill with it. She still needs cash. The cash world is still very relevant, mostly places in the globe.
Sweet. Pete, take us home.
Yeah, I mean, I'll just add super quickly because I think there were a lot of good content here. And we're kind of in a similar position in that we utilize stablecoins every day. We move stablecoins every day. We're not in the business of holding stablecoins either, right? So we're going to receive stablecoins. We're gonna burn them off. We're gonna use, like, let's say if it's a Saturday, we're gonna use RTP rails, and we're gonna go back to fiat. That's a position of just concern of the asset, of the stablecoin asset, the lack of insurance to the asset, and obviously the comfortability we have with fiat strictly as well. Mind you, like, we're basically balancing to zero every day. So all the inputs that come in, all the funds that come in, equal funds going out. We're kind of think of it as like a $0 balance account at the end of the day. So we're not really in the business of holding these. I think from a consumer perspective, I think especially outside the U.S., you're seeing people that are very comfortable holding them. And I think even to credit for Malcolm, where they're having a wallet, the consumer's going to hold that stablecoin. They're going to hold USDPT. And that's really a wealth preservation mechanism for them if they're sitting in Argentina or Turkey. It's really awesome. I like what they're doing. And I think there's comfortability in that. So I think actually you're seeing consumers, to be fair, especially outside the U.S., that are actually more comfortable with this than actual businesses. That should change over time. Brian made the point about SoFi's stablecoin as well. And we'll see how people utilize these these like BIDL funds and other things over time and how they gain comfort with that. I think we'll see the progression.
Love it. You mentioned chargebacks, fraud protection, all of the stuff that people who hate stablecoins bring up when they want to try to say that stablecoins don't matter. So I want to talk about this. Pretty much all of you up here have had organizations that have spent decades and hundreds of millions, if not billions of dollars, solving these problems, the fraud, the chargeback, you name it. What does that look like in terms of an asset that can be sent and instantly final from point A to point B? How do you guys build out those mechanisms?
I can go first. So we already work in an asset that exits and is final and goes out. Yeah. It's cash. So for us, moving to the stablecoin rail and the stablecoin actually brings in more capability than we have today. So if you send money fraudulently to somebody in a country and they walk out with cash, the second they walk out, even if the store doesn't catch that fraud, it's gone, it's done, it's dusted. So that chargeback, that recovery and the money transmit flow is very difficult, which is why we have all the controls. In the wallet side, you have the ability to track it through chain. You can freeze it, you can pause it, you can recheck it, you can revalidate it. You have plenty of tools out there that look for bad actors, look for known institutions that are doing this. Our friends in North Korea do this very often. They also defraud us in cash as well. That's just the name of the game. So I think you have to look at the benefits that this brings you in an on-chain experience. So people think of on-chain as, there's a dark web, the DeFi space, the people, moving funds around and money laundering. There's also this great, ability to track it right through the chain until it turns up in your store and you have that moment to do that. So the risk is still the same, whether it's cash or stable for us. It really doesn't change. We just have a few more tools on top.
Yeah, I won't try to repeat, I guess, what I said before. I think personally, I believe in a world in which it's less likely to be sort of any sort of reversal type of technology that's introduced. I do think I like this idea of there sort of being a forward refund where you see the transaction that went through and that gets put on the blockchain, but then you also see the fact that an equal transaction also went through, reversing that transaction. And that's pretty interesting in terms of just being able to view what the history is of a particular wallet or whatever it might be. Outside of that, I think most companies or acquirers, or maybe it's going to be the issuers or the merchants themselves, there will have to be some sort of reserve that's maintained in order to kind of execute against those sorts of things that we expect to happen anyway. Again, I think it's going to take the effort of a lot of companies coming together to agree on what those rules will be, what those definitions will be, what is the process that we want to kind of put out there. But again, it's a matter of time. I think the one thing that I'm also quite interested in is once we move to a world in which transactions are machine to machine, so machine to machine payments, this can get pretty novel when it comes to this type of mechanism because a machine is, not going to be a North Korean sort of example that was mentioned here, although I guess it could be backed by them and coded by them.
It's pretty much going to be North Korean.
But all to say that you can look and inspect the code itself and you can code within that this type of functionality. functionality, especially for those type of transactions, which you would have to believe are going to really increase in volume and magnitude over the next few years.
Yeah, just to add, so I do think when it comes to chargebacks, disputes, like you're talking about, like these recall functions, I'm going to sound like a Visa maxi, but Visa has solved that, right? They've like set those rules, and I think stablecoin cards are a really good, I guess, next step when it comes to people actually spending with stablecoins, but still getting those consumer protections of being able to say, like, I didn't sanction this transaction, my card got stolen or something like that, and you can get your money back. And Visa's been doing that for a long, long time, right? And when it comes to stablecoin cards, the beauty of them is it's still the same UX. It's your Apple Pay, it's your Tate, which is a great payments experience, right? Like, I don't know if you get less friction, right? If you actually get less friction with probably like Apple Pay and it just scans your face when you go up to the terminal and it just knows to pay, that's probably uncomfortable, honestly. So it's the perfect amount of friction. So it's kind of already been solved. So when it comes to the chargeback stuff, the stablecoin card, it lets stablecoins do what they do best, which is operate on the back end. And then Visa can still handle like the chargebacks and disputes if we need to. Now, if you're going to take that outside, let's say, of the like stablecoin linked card world, and people just have QR codes at their merchants, and pay my Coinbase wallet, well, you're going to run into a lot of trouble. There are interesting technologies like recall functions. You can put a wrapper on a stablecoin. That stablecoin can be sent. You have 48 hours to reclaim it, but then you run into more issues as well. So the problem is like with chargeback and disputes, we might be able to get to a point where a consortium could do it, but it's really got to kind of be somebody in the middle playing cop, right? Saying no, this is the dispute, this is what they wrote, this is what happened, we got to get the money back now. So you kind of do need that type of person in the middle, at least for now.
Thank you, Brian. That was good. That was good. I kind of echo Brian's sentiment there, and really settlement is net settlement is disjoint. So what's happening, with the consumer and their spending and their returns, cancellations, what have you, that all kind of reconciles out in a net settlement world because this is all being batched and settled as a whole for our card program, to Brian's point around these like stablecoin linked cards. So they have that stuff built in, which are the consumer protections people want. So I think we've given the people what they want, I hope, and they use them. I use it personally. Like I have an EtherFi card. I'm maybe earning 6% in a DeFi pool, and I'm spending it down. Yeah, you like that?
6%.
Yeah. So but I'm getting all those protections as well. So like if I want to return the shoes, I return the shoes. And it functions, right? So I think we've built well for this. And then kind of to the comment of like, let's do direct accept of crypto, right? Well, obviously you can do that. People do that. There's some merchants that do that. But if you're going to have those functions, like an ability to like get a refund, return whatever, and you're, let's say, wrapping it, putting a smart contract on it, and not necessarily releasing the funds kind of wholly, well then there's no like all that kind of allure of like the atomic nature of it just goes away, right? So it's like be careful what you wish for, right? Yeah.
I love it. We have about a minute left here, so we're going to do one more question on kind of a speed round. Talk a little bit about timeline. Lots of regulation stuff popping up, lots of technology that's rapidly improving. Right now, though, stablecoins are still really, really, really small in terms of proportion of total commerce, proportion of total payments. What are your predictions on timeline? And this is the opportunity for you guys to either look like geniuses or get quote tweeted later on and made fun of. So, Pete, why don't you start? We'll go down the line.
All right, let's make fun of me
It's
first.
your hot one, huh?
Yeah. So like timeline, it's now. Like we're doing this now. Like the timeline is right now. We are moving money via stables right now, full stop. That's continuing to grow. Every month we do more than the last month. So the timing is now. The complexity, I think, revolves around the regulatory or the lack of regulatory clarity, because that's still a big question mark. So hopefully that gets ironed out. But that's kind of the biggest thing I see.
Yeah, I would just say that it's the enterprises that are really going to push this industry forward. And you saw that, when Bridge got acquired by Stripe, that probably paid for a lot of people here, right? So I remember that day actually when it happened. I talked to people like, wow, our team just got more important. So it's going to be the enterprise that keep pushing it. But, I don't know if you guys know Jack Zhang, the CEO of Airwallex. I don't know him. I know his name. But he actually tweeted out, I remember, a year ago saying, like, why do we need stablecoins? Because his company has spent the last 15 years building like local on and off ramping in 100+ markets, right, in order to make cross-border payments seamless. And kudos to him, he did it the hard way, right? Unfortunately, stablecoins are now enabling companies like Sling, which is like a Venmo with stablecoins on the back end, right, to expand to 150 markets within 2 years. And that's just like the what we're in now, right? You can access these markets from day one. And that's why people are building on stablecoin rails, right? Who wouldn't want global accessibility? So it's just it's an inevitable, right? Like money should move at the speed of the internet. When my mom asks what I do, that's what I always say. I make money move at the speed of the internet. And so if you believe in that, then you're going to need, you know, full stack infrastructure to get all these companies on chain. Not saying all money will be on chain, but a lot of it will.
Yeah, I mean, I think one thing that like I always want to level set is like very easy when you're in these types of rooms to like kind of get, you know, high in your own supply of like what we're doing, like the money movement and internet. The thing to really kind of check yourself is like the real payments world is so much bigger than what stablecoins represent. And these type of things are both reliant on network effects as well as sort of technology and compliance gaps to kind of be closed. I mean, I think like the Visa network, which I guess was called something else back when it started, it still took like 25 years to kind of become like widely accepted and used. I think, you know, with technology today, it's probably going to be half that time to kind of reach that when it comes to this type of asset. So I think by like the early 2030s, it'll be sort of ubiquitous that stablecoins are like accepted as a payment method. But even then, I don't think they will be the majority of transactions, but they will be a significant portion of like cross-border and sort of a lot of those types of use cases.
I think for me, the story I tell the exec team in Western Union, we're a 3 to 5 year journey. So the game is scale. So it's easy-ish to get the infrastructure stack, get the stablecoin launched, issuing bank. You know, liquidity is a little bit harder with exchanges and OTC desks. Then it's scale. So much to the point here. It's going to take a period of time for that scale to take place. Consumer acceptance is not the game here. The underlying infrastructure will start moving the coin. Consumers will get more comfortable with use cases. There are very few stable coins that have vertically integrated use cases that consumers, the general consumer, not the crypto bros or girls or people in this room high on ourselves, will hold stable coins in wallet and earn against that. So those vertically integrated use cases will start driving out, but they take time. So stable card are issuing later this month. We get really quick into a number of markets versus a general issuing program. They're going to hold US dollars for certain markets, as Peter mentioned. They already do that today. That's a win. The US customers, they're not going to hold US dollars in a card. They already do that. Like, why do I need a stable coin? It's novelty. So I think because of that, you're on a journey which has very much started. It's a back-end thing. In some regions, it will be front, but it's a 3 to 5 year journey for us where we're not going to be fully ramped through for that period of time. And we'll always use fiat.
Love it. Love it. Ladies and gentlemen, these are 4 of the smartest people at 4 of the most influential companies in all of stablecoins.